Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hi, everyone. Welcome to the Small Cap Discoveries conference call. Today on our call, we have CEO Joseph Nakhla from Tribe Property Technologies. Tribe trades on the TSX Venture Exchange under the symbol TRBE and on the OTC under TRPTF. The company is currently trading at $3.60 with roughly 21 million shares outstanding, or about a $76 million market cap. I'd now like to hand it over to Paul Andriola.
Thank you so much, Trevor. Good to have Joseph back. Joseph, we spoke before, not in front of our audience, but we had a chat several months ago. So happy to have you back here. Joseph runs a company called Tribe Property Technologies. Tribe is a property technology company that is digitizing the traditional property management industry. So he's here to tell us all about it. Joseph, thanks for joining us, and I'm just going to hand it over to you and let you go.
Thank you so much, Trevor and Paul. Pleasure being with you again, and it's nice to see everyone on the channel and share with you our story as a company. A little bit about myself, very quickly. Civil and structural engineer by trade, somebody that has passion for city living. I cut my teeth in technology in the late 90s with a company called TO Networks that was trading on the TSX Venture, and we had a wonderful exit as we grew the company. It was an overnight 17-year success, and we had a great exit with PayPal. And my next passion was to tackle perhaps a problem that a lot of people can relate to, this concept of people living in cities, living in buildings. I felt that technology can play an interesting socioeconomic role in how we connect in these communities, and that was the birth of our tech-backed services company, Tribe. I have a deck that I'll be sharing with you, and happy to take any questions right through the process. I'll leave it up to Paul and Trevor to quarterback that, but don't worry too much about my flow. We are almost 1 year on the dot trading in the TSX Venture. We are a company that really focuses on delivering tech-backed services for two big sectors of residential living. The first one being the condo space, strata if you're in Western Canada, condos in Eastern Canada. In the US, it's called homeowner association. It's that concept of people owning a home, but it is a part of a larger community with quite a bit of interests. And on the other big sector that we service is what we call institutional rental, this concept of big apartment buildings that are actually built or managed and or owned by big landlords, REITs, and alike, family offices, and they're looking for companies to come in and actually do the full digital and operational management of these communities. In this case, we've grown quite a bit. 2018 was our foray into the space. We had zero under management. Fast forward, after a number of acquisitions and organic growth, we made 8 acquisitions to date, and we are considered to be the 6th largest condo management company in Canada and the 6th largest rental management company in Canada. Again, everything we do is with our technology, with more than 70%, 100% of the communities are digitized, and about 70% home penetration with the actual homeowners. Year over year, we're pleased to announce that we, as of 3 quarters of last year, we have not announced our 4th quarter yet, that we are at 250% quarterly year over year growth, with about 340% improvement of gross margin and a very, very, very low customer acquisition retention, which I'll get into in a second here. And we are a national company within the boundaries of Canada. A little bit of history about us. I shared that with you, but really the biggest milestones that we've done so far in our short history is we've acquired some companies. You'll see 1964 there. So we've actually acquired some companies that have been around since 1964. So that's our way of saying we've got quite a bit of expertise within our executive management of the space. We lit up our first building under the Tribe management brand in 2017. 2018 was really our coming out party. 2020, we acquired a company called Gateway, which is the national player in the Canadian realm, and went public in 2021. And just most recently, I think right around the time Paul and Trevor connected last time, we were maybe just about to close on a private placement, oversubscribed, thankfully, for $21 million. Was led by Round 13 Growth Fund and a couple of big funds out of the Canadian landscape that were either already shareholders of ours or new shareholders that came on board. And we set out to raise 15 million at that time. We solve a very specific problem associated with the way people live in these communities. If you've ever lived in a condo, your probably number one complaint would be lack of communication between you and the condo corporation or the property management group. It's very, very paper-based. There's lack of transparency. It used to be okay when condos used to be $40,000, $50,000. It's becoming more and more of a problem when you consider, you can't even enter into the downtown core of Toronto or Vancouver for less than $1,000 to $1,500 a square foot. These assets now are incredibly expensive, and they really need to be managed properly. And the old school way of doing it, which is paper-based and kind of knowledge sitting in your inbox, is no longer sufficient. There's got to be a much more sophisticated path to support these communities, and that's really what Tribe brings to the game here. The other big problem is lack of consistency in the service delivery as well. So a good property manager could exist in a company, but the one next to him is not very good because there's no service delivery standards in the industry, and it's all kind of topped with a big problem that nobody talks about, which is for property managers, actually they need to be licensed, and that licensing requirement is becoming more and more rigorous and difficult to achieve. And there's actually a shortage of the people to render that service. So companies like us that have the ability to convert the ratio, meaning we can manage more communities and more buildings with our technology with less number of property managers or licensed property managers, really gives us a massive advantage. How do we do it? We digitize everything about the building, everything about the home, especially in brand new communities where we work directly with the developers. Think of your home being completely digitized. All your serial numbers are in, all your warranties are in, all your floor plans, everything associated with the home is digitized. Along with the building, we digitize the full building as well with all its amenities, all its bylaws, laws, rules, permits. Any workflow associated with you living in that community is completely available to you at your fingertips. We also have a really cool marketplace whereby with the data we have about every home, we actually marry the potential needs, home needs of the residents, of the tenants, of the homeowners, or even the strata councils with service providers that can actually deliver great services that are actually leveraging the group buying power. We service almost 100,000 Canadians now living in about 40,000+ homes of our communities, and that relevancy of that is to kind of orient you a little bit. So I mentioned earlier, we're the 6th largest on the condo side, but what's interesting is we're actually the 3rd largest, or the 3rd only company that's national. The other companies are a company called First Service, public company, multi-billion-dollar US company, and a company called Associa, again, a US company, private equity backed, and then us, the 3rd company in that market. We do have digital services right across. So if you live in our community and you want to book your amenities, you want to make a payment, you want to look at your financials or the financials of the building, it's all available to you again from your app. And we still do the full property management work. And I want to make sure for those of you that are not familiar that you understand property management isn't the function of sweeping, cleaning, doing the actual work that you see in the building. That is contracted through our platform. Property manager is actually a licensed group or entity or a person in our case that actually helps the strata councils navigate through the challenges they've got. In the case of a rental building, property manager is responsible for leasing up the property, so finding tenants to move into the property, and also with the predictable and in some cases non-predictable events of maintaining the building. We make money 3 different ways. First way is the first method is software and service recurring business. So we actually license our technology into the community along with our services. We don't nickel and dime. It's all one flat rate for the community. And that's about 70+% of our revenue is that particular sticky business. The second way we make money is transactional revenue. Once the community or the home and the community are digitized, for the homeowners to interface with the community, there's many things that they need to book things, to make payment using credit card, pay their rent, receive historical documentation. All that stuff is done on our application, and for that there's fees, and that we call that transactional fees. That represents somewhere in the neighborhood of about 20 to 23, 24% of our revenue. It's very sticky as well, but we treat it as a transactional revenue versus the steady licensing fees that we get from our software and service. And then the third small but growing and exciting part of our business is the ability for us to help you as a homeowner to purchase products and services, insurance products, financial services through the platform, and we actually make a transaction on that. And we disclose it. We really like to be over transparent with the way we communicate and manage these communities. But you can imagine there's all kinds of Internet of Things products and services that are needed in the community. There's products for like home monitoring or water detection systems for your own home, insurance products. There's a long list of products and services that we're working on bringing into these communities that we can monetize. And really the key thing is to bring products and services that are actually operating at a cheaper, making it available for our homeowners at a cheaper price than they can get in the market. That includes something like TELUS Triple Play, for example. Like I said, 2017 we piloted the products. 2018 we went to the full market. Since then, we have about $11.5 billion of assets under our management. We collect in the neighborhood of about $400 million that go through our pipelines between rent and maintenance fees. We don't recognize that as revenue. We only recognize the revenue on the services, as I mentioned earlier. And we have about 350 million community data points. We know who lives in the unit. We have a payment relationship with them. We know how often they renew products and services. We know if they have pets, if they have children. All that data that we have are relevant because it allows us to actually curate some really interesting products and services in front of them. The market is massive. I don't think this will be a surprise to anybody on the call, but more and more of the West is moving towards these types of communities. People are either empty nesters or no longer can afford a single family home. And you'll see a lot more of those land assemblies where developers are purchasing the single family homes and actually converting them into multifamily units. Some are big towers, and I do want to make the point that I don't want you necessarily to walk away thinking we're for the high-end communities. We do manage some really high-end communities, but we've got stuff that still needs the same level of services that we've got at a much lower square foot entry point. So really, this is not exclusive to the higher end downtown core types of buildings. If you looked at a profile of our communities right across, and we're nearing 1,000 of them now, you'll see them in every shape and form and every socioeconomic model. And the point really to take away there is that this is a service that's really required, and we can now with confidence say it's recession-proof and pandemic-proof, especially when you consider the growth we experienced over the pandemic. The rental market is also massive. A good way to think about it from a Canadian lens is there's about 200,000 condos being added every year to the Canadian market. About 75 to 100,000 apartments are being added to the market. What's really interesting is that out of this 200,000 homes being added in the condo space, 30% of them are going to be rented out. So they're going to be bought by investors to be rented out, which is also a division we have and a suite of software products we have to support that particular market segmentation as well. This is our geography footprint. The takeaway from the slide is to let you know that the particular markets that we want to be in isn't necessarily in every province and in every state. We really need to be in dense markets. You can argue, 10 to 15 markets well, I know that it's about 12 to 13 markets in North America represent about 75% of the addressable market that we're seeking. So in Canada alone, by being in the markets we're in, we're pretty much more than 85% of the addressable market of Canadian soil. So this is a density play for us. What's unique about us is a holistic approach. We have actually a suite of products for developers. This is real estate developers, and we have obviously platforms for our community that we manage, whether they're rental or not. And then we have full management services that sit on top of that with a suite of products for landlords, whether independent landlords or big REITs. So it's the most comprehensive. I would absolutely argue that it's the only one-stop shop for both institutional rental and condo communities in North America. It's complicated because the number of stakeholders that we service. This is just a snapshot of what is probably an obvious stakeholder groups that have to coexist and have harmony between them in any of these communities that are erected. So most people think of a condo, you know, you go in, you go out. It's not that simple. There's different groups within each one of those, and the definition of success for each one of those stakeholders actually is different. This is a good timeline overlaid with the digital and services that we offer for our communities. And what's interesting here, you'll see that we actually exist and start delivering services as far out as 2 to 3 years before the community is even built. I'm live in a place called Port Moody here in British Columbia, and from where I am, I can see some of the developments that are actually coming up that we will be managing. But I already know that we've already set the budgets for them. They currently use our software in their sales centers, and it's actually starting to, as they get erected up and come close to completion, we see a lot more usability of our software to get the building ready. And once the developer completes it, hands it over to the homeowners, a new wave of services and tools on the platform start showing up. Our focus when we wake up in the morning is twofold. One, expanding our footprint. We expand our footprint through organic growth. So this would be traditional buildings in the condo space or the rental space that are being managed by somebody else, and then they come to us, or we work directly with the developer, building brand new communities and take all of our digital services on top of that. Or something that we've been actually getting really good at, which is actually buying traditional property management companies and converting them to our service delivery model. And we've made 7 property management acquisitions to date and 1 tech acquisition to tuck into the services that we offer. All of that is the way we increase our footprint. So we don't just organically grow, although that's going really well, but we also grow via M&A. And we don't just buy these companies, we actually convert into our service delivery model. Once we've done all that, the second big focus of ours is to not only manage these communities properly, but also introduce revenue streams or revenue opportunities for us by way of lowering the overhead and management expenses of the community and delivering some really great services for the homeowners themselves. And you'll see some examples of that. But we don't just grow by M&A. Organic, our what I call traditional SaaS journey or client journey is very strong. I'm happy this I didn't share with anybody before. I'm happy to share with you guys now that our 2021 numbers are there so we can compare them. You'll see in 21 we had 503 leads. These leads came, which lead would be a full building coming our way, and you'll see that was a massive increase from 2020, and win percentage still runs at about 30%. We are never the cheapest. It's not a price game for us. If anything, we tend to be the most expensive all the time. However, we're holistic in terms of we give you all the services that I spoke to. We don't just nickel and dime on these services. Cost per lead is coming incredibly lower. That's probably mainly driven by reputational expertise. And you'll see our lifetime community value is really high simply because we just don't churn. The industry churns at about 10 to 15%. We churn at less than 3.5%. So my definition of churn is the proper definition of churn. It's how many homes that we manage starting from the early in the year and how many of them are left in our docket. We're still growing by 250 to 300%. I'm just talking specifically what we started with from the year to the end of the year. Our M&A playbook, in a nutshell, we rebrand the company, we put our IT infrastructure in it, we optimize the service delivery, improve the gross, the profit margins in it, and we actually take it, frankly, from playing defense. Most of these businesses are kind of flat-lined, and we go on the offense in that market by going out and actually starting to acquire more business. Some examples of acquisitions we've made, as I mentioned earlier, is our 7 property management acquisitions that we've done. And we have that engine of the more communities we have, the more desirable we are for people to sell products and services. If you look at my daily schedule, I'm getting more and more conversations with people that want to sell more interesting products and services to our communities, or want to digitally partner with us to deliver some really unique services for these. And if you look at our long list of press releases we've done in the last 12 months, you'll see some of them, more and more of them are with regards to services being rendered for the communities that we manage. Everything we tend to put out will be revenue generating for us and lowering expense for that particular product for the building. Nuts and bolts, microeconomics per home. This on the left-hand side is what traditionally the industry does. So a traditional property management company will generate $20 MRR or monthly recurring revenue with about $2 operational transactions, 30 to 35% gross margin, and 10 to 15% churn. It'll tend to be flatlined in revenue simply because, unfortunately, it's a C-minus business, so 10 to 15% churn that leave this company, and 10 to 15% leave another companies. They come to you. So kind of the revenue line tends to be flat. But if you actually look at the method of churn I shared with you earlier, you'll see it's about 10 to 15%. What you'll see on the right-hand side is the result of 3 quarters of ours last year. So this is real live data. $26 per home is what we generate in MRR versus 20. Plus we add another $6, what we call operational transactions. It's compared to $2 there. We are running at 50% gross margin. This is holistically for the business, inclusive of all of our technology expenses. And 4% churns, 3.5, but rounded up to 4%. And then on that little table there is intended to show you 26 and 6 is a traditional revenue for us. This is our services and technology or software SaaS revenue. But you can see on top of that the opportunity for us to add more and more services. These are running at 100% gross margin practically, because when you do get a product purchase on the platform from there, it just hits our bottom line. And it's still very young. We've only announced that about a quarter ago, I guess 2 quarters ago now. We're in the second quarter, but it is going really, really well. And it is going to be continuously going really well because of this pie chart. This pie chart speaks to generally an average household income that lives in a condo or lives in an MDU, even a rental community. This is where they tend to be spending their money relating to their home. And all these different, there's obviously other things they spent money on. This is not included here, but these things that are related to their home are areas we can really influence. And we have relationships or creating relationships with service providers in those areas of the market. Good example of that would be these 2, again, data-driven slides. You'll see we took Apollo. It's a digital insurance, condo insurance service provider. We launched with them in July 21. 15% of the people that actually use our platform to get a quote from the underwriters that Apollo are delivering purchase the insurance policy. And every time they re-up, we also get compensated. TELUS launched with us, and we launched that in 21 and put it in brand new communities prior to people moving in. And we said to them, look, hey, congratulations, you're moving into your new home. You've downloaded your Tribe Home app. And we kind of orienting them about everything that's available to them. And we say to them, did you know we negotiated a triple play offer for you with TELUS? And in the buildings, we lit this up into 20% of people took on the product, and we make a commission per product as well. And again, we disclose all these to our customers. So envision now how this can be a path for us. Is you're going to see some quite a bit of movement in 22 in this area. Some examples, not to impress you, just to impress upon you, give you some visuals of what condo communities that we manage look like and some of the developers that we work with. And here's some examples of rental communities that we manage all across the country as well. So I mentioned growth. This is fiscal year 2018. We did about $2 million, about almost 3 million, 4.2, and we've signaled to the street we're going to do between 15 and 16 million of the year that just finished. We haven't announced our Q4, but we're very much on track based on our 3 quarters that we've shared with the street. Perhaps more importantly is this slide on the top right-hand side or the chart, where you can see that not only are we growing our revenue, but more importantly, this is our monthly recurring revenue per customer. We call it per community, but per customer. And you see that while we're really, really growing in top line revenue and growing in the number of customers that we have, we're also sustaining our ability to drive more revenue per customer. And that's really the most interesting thing about our business, if I can say that, is the ability to be more relevant to the communities we're in and continue to practically have endless revenue streams from these communities. Just go deep in that particular relationship. Very, very high level, very tightly held company. Basic share outstanding is 21 million shares, fully diluted 28 million. Quarter of the company is in the hands of the founders, directors, managers, and about 40% is industry strategic investors. These are some of the big names. You can probably dig them out. The who's who in real estate really in Canada is behind this company, all long holds. And then you'll have seen some of the announcements with some of the big names that we brought in, including round 13 that came into this last round, took half the round. We did 21 million, they took 10 million themselves. And that's institutional, heavy institution. And I'll be honest and tell you, we don't trade often simply because we are thinly traded due to the fact that it's tightly held. We are doing things about it this year, and we're going to get the word out, and starts with speaking to great folks like Paul and Trevor here and you guys to get on your radar. But that's the reality of where our company is right now. Great group of executives that come from different walks in life, a lot of scalability, businesses that have been grown and sold, and a lot of industry expertise as well. And a very impressive group of executives on the board. 3 of them are independent, which is something we're very, very proud of, and including our chairman. And it's an area because of the future of this organization, certainly to qualify out of the TSX and move into the Toronto Stock Exchange and obviously NASDAQ eventually, and independence for this organization and high level of governance is very important, especially for the big funds that are more interested in us as we move from the microcap region to north of that. So to summarize, we're disrupting a very outdated yet fastly growing industry, multiple revenue streams in our business. We have very strong market penetration in the last 3 years, and we continue to grow. And we're also solving a problem that's very, very evident and in reality existing in the world of the US as well. Very aggressive M&A and a real playbook with a true M&A team that's actually essentially digesting these organizations that we're buying. Very strong cash balance, $20+ million, practically no debt other than vendor buyback, quote unquote, loans on our books that are intended to be hand in hand over the next 3 years with specific milestones for the groups that we purchased companies from, and just a lot of catalysts on the docket. So I spoke very fast. I hope we satisfied the time restrictions, and maybe I'll stop sharing.
You did perfectly. As a matter of fact, you did so well that you make my job easy, because I've got very few questions to ask you, but I'm gonna ask what I can to feel relevant in this discussion. Joseph, I mean, you talked a bit about sort of how big this is, or as far as the industry, but I really want to get a better understanding, and I'm sure listeners would as well. How big could you guys get? I mean, clearly, the sort of the condo and rental market in Canada is massive, but give us more tangible numbers. How big could you guys get in this scenario?
So we mentioned earlier, we have an M&A corporate development team and an M&A integration team. One of the key things I want listeners to understand as it pertains to our M&A activities is we don't just buy companies to play an arbitrage game and let them be, and we just kind of recognize all the revenue. We actually buy them to really convert them from a service delivery model to start realizing not only improvement on efficiencies, but also, as you saw that chart that illustrates that we can continue to generate more revenue per home that we're actually acquiring, which I think is a really key part of our business. So for that to occur, we have to be on top of our game from an M&A integration point of view. And we've spent 21 putting together that team and preparing that team and fixing some of the areas that we thought that had some gaps. So we're well positioned to really activate, to orient everybody from an M&A point of view. There's more than in the size that we like in Canada and the US, there's more than 1,500 independent property management companies. The space on the condo alone the market in the condo alone is about $130 billion annually being spent on maintaining condos, HOAs, or stratas. They're all interchangeable definitions. So you do the math on that, and you can see there's a significant amount of those M&A activities for us. We haven't signaled the street on what we expect to do this year, this calendar year. We're doing that shortly. But I will tell you, within our M&A pipeline, we've got a path to $40 to $50 million of annual recurring business that can be tucked in, and this is before we even cast the net further down south.
That's fantastic. And then, as far as like your M&A pipeline right now, I mean, are you guys looking at a lot of deals? You're looking at a few deals, and then how long do you typically take from finding something to closing on a deal?
Yeah, great question. I believe in our M&A pipeline now, we're in the 25 to 28 deal type of area, different stages, different sizes, and arguably different geography and sectors as well. Like some are active in institutional rental, some are active in the condo side. Typically, I'll share with you some numbers based on averages. However, these vary based on size, but typically from the moment we sign an NDA to the moment that we conclude our M&A, early due diligence, and then offer, and then LOI, and then closing, that period tends to be as early as 90 days, as long as 180 days. It depends on obviously the size of the deal. Compliance is something that we're really good at, so we've got the engine to get through that. So that would be kind of the high level. We've done things a lot quicker than that, and anticipate to do that. And the integration, once the closing occurs, and that business now is a part of our umbrella, and integrating it, we've integrated as early as 6 weeks and as long as 180 days.
And then generally, do you prefer to buy these out with all cash, or do you want to see some of the management team or somebody still have a vested interest in the company? I mean, you're a public company, you've got your shares as currency. Is that something that these sellers like to own?
Yeah, it's a fine balance, because a quick answer is I really do not like dilution. And I'm sure everybody here would appreciate a CEO saying that, but I generally don't, especially when I feel like our company has arguably a much higher, or undervalued. And again, there's not a whole lot of CEOs you talk to every day that probably don't agree with their own thesis that they're undervalued. But in our case, it's at least fundamentally we believe that's supported. However, to your point, there is value in our currency, absolutely, and especially with acquisitions with people that really have hit a bit of a ceiling in their ability to grow the business, but they still have a little bit of horsepower to give back to the industry and actually want to see that grow. So we'd like to give them an opportunity to see that upside with us. And so traditionally we'll approach it with 1/3 cash, 1/3 stock, and 1/3 vendor buyback based on a suite of performances. We're flexible and we can move around as we need to. It's also good and important for you listeners to know that our business is very, very serviceable. We have a lot of debt that's available to us. We haven't leveraged that much right now, but that's becoming more and more evident that it's an area that I'd like to actually explore. Purely based on its senior debt, it's not venture debt, and a lot of the businesses we're buying and generating cash. So we're a really good place to be able to use that as a leverage as well.
Now, I want to remind everybody that's listening, as always, if you've got any questions you'd like me to ask Joseph, please use the chat function, and I'll do my best to ask the question. Okay, so you raised a whole bunch of money just recently, like you said. I mean, use of proceeds, I'm assuming, is going to go, majority anyway towards acquisitions, but are there other uses of that cash?
No, you're correct. Acquisitions is obviously a big driver for us. The other big area is product development, but specifically in the two-way marketplace. So we're all familiar with your traditional Angie's List or Amazon Home or any of those products. They're great. They're really, really, really great for single family, but there's very little in the market. Actually, there's none in the market that are designed specifically for condo corporations or buildings or people that live in these communities. We think there's a big play due to the data that we have to really curate even more services and put that in front of customers transactionally and really simplify the living of these homes a lot easier. So these are probably the two big areas. I would also say that we've got to continue to invest in attracting young graduates into this space. The industry's really ignored that, and that's not to say that's going to be a massive source of capital allocation, but it's certainly an area that you're going to see us make moves in. This concept of bringing sexy back to property management. I say that as a joke, but it's quite funny. I talk to a lot of entrepreneurs that have built great property management companies and they want to sell them, and I'm always curious, well, how come the kids aren't stepping in and taking over the business? And they often say, oh, they think it's dreadful, it's paper-based, it's not a cool job. And until I start talking to you guys, I wasn't even a cool dad or a cool mom. And it's funny because you actually look at the profile of the staff that we're attracting to the company, where I think our organization alone is lowering the age average of the organization and trying to bring in some really interesting and open the eyes to younger professionals that this can be an amazingly fun job. Great flexibility. You can work remotely if you have our technology, and it's incredibly satisfying. So that's going to be an area you're going to see us be more active on, both in the press and industry specifically.
And Joseph, so we understand when you acquire a company, you sort of bring in all your services, you sort of upgrade the systems of these companies. But how about outside of that, like you're sort of out in the trenches, fighting it out for business. Sort of organic growth. How do you get that business? What kind of sales process? Is it RFP based? Is it, do you know when a contract's going to expire? Give us a little bit of color there.
Yeah, I'll give you the segmentations of where we play, because the enterprise sales process is a little bit different. I'll start with arguably the most complicated one, which is the condo corporation. There is no list. I cannot go and buy a list of the presidents of the condo corporations in Canada or in the US. That doesn't exist. But I shared with you earlier a slide that spoke about our ability to really get quite a bit of leads. How did that happen? Well, we do that by creating some really good, hopefully very relevant content, digital content, and put that out to be consumed by people that are living and breathing, especially on the condo corporation, living and breathing these problems. So they kind of read about it, they understand how technology can solve a problem. And believe it or not, it isn't always saying, oh, you got to come and use our technology, or you got to come to us. It actually, sometimes it's written in a way to give the temperament and expectation properly, because there are companies that actually are buildings that are being managed by good property management companies, and people don't know that. They should know that, and they shouldn't leave and come to us. They should stay where they are. There's so much more business for everybody to achieve the goal, that if they got a model that's working for them, that's great. So once they come in, we have a nurturing dynamic whereby they keep getting more content, and when they're ready, it does go into what looks like an RFP proposal, RFP process, and we tend to win 30% of that. And the number one reason we don't win is price, because we are convinced that the value they're receiving, they should be paid for. And so that would be that particular most complicated path. Brand new construction, we've got the most comprehensive suite of software products that really lower expenses, significant expenses for the developers, real estate developers. So we tend to win a lot of that business. And I'm happy to say, we don't talk much about it, but we've contracted significantly more than what we've actually spoken about today. We have a lot of deals that are contracted for the future. It's just the buildings are not up and running yet, so the recurring revenue hasn't kicked in yet, which is a great line of business for us. But that tends to be an enterprise sales business that's aided by the fact that we have the most comprehensive solution with all the integrations in it. And then on the rental side, on whether it's a REIT or a big family office, as they go out there and build a brand new community or buy an asset from another REIT, there's only 3 big national players. So the phone rings and say, listen, confidentially, we're about to buy 3 towers in downtown Calgary. We want you guys to come in and manage that for us based on the services and the technology that we've spoken about. And that model continues to grow for us significantly. And then finally, there's this little kind of independent, rogue, nobody understands model that actually is a massive underserved part of the country, which is 1/3 of our condos in Canada are being rented out by investors. And that kind of no man's land space, we're really well equipped to service, because if we are in that community already and you have our services, we just let you know that we can also, if you ever wanted to move out and rent this unit out, we will actually have the technology and the service to do that for you.
Now, I want to go back to M&A just one last time. What we didn't talk about is typically when you buy these companies, what kind of valuations are you buying them at? What kind of metrics?
We've bought as low as 0.6, 0.8 times revenue, as much as, if the company is really, really profitable, as much as 1.2, 1.3 times revenue. Again, the characteristics of most of the businesses we're buying is what I shared with you guys before: 30 to 35% gross margin, probably not growing, and flatlined, and probably high churn, 10 to 15% churn. If somebody's probably curious, why aren't you buying on EBITDA multiples? It's just simply because a lot of these companies, they're kind of managed in a way, the financials in a way that's difficult to nail the real EBITDA. There's quite a bit of exchangeable things between the owner of the company and their home and mortgage and cars and all that stuff. So we tend to just be, from a guiding point of view, we're just going to use that line before we normalize that EBITDA number.
And then, Joseph, what you sort of talked a little bit about, trying to find more young people to enter the industry, but what are the bigger challenges you're facing running this business?
Well, it's I will point well taken on your side. You're bang on. I mean, bringing the right qualified people in the industry is critical, and that's not necessarily to say, oh, our business is all people based. It's not the reason. The truth of the matter is, any condo corporation in Canada and the US does need to be managed by a property manager, and that will not go away. If anything, more regulation and more license requirements is coming, as more and more, as as a lot of us probably will remember this tower that fell in Florida and killed a lot of people. That's a function of really lax regulation, very lax and muddy rules and responsibilities around the property manager and the condo corporation itself. That's changing as we speak. There's going to be a lot more regulation there. So I would say that's one area of concern is more and more of us are moving into these communities. More and more of these communities are being erected. Yeah, there's less service and more regulation coming in. So I see it as an opportunity, but I do live the challenge daily. So I will tell you that's an area that needs to be seen. And then the other more interesting challenge there is really, what does a low carbon footprint community look like? I think it's, obviously globally right now, that's a big topic. I mean, certainly not today or yesterday, but that's an area that I think is completely underserved. We understand there's regulations around LEED and how do you build a really cool building that's operating properly. I hate to say this, and actually saddened to say this, a lot of these LEED buildings, where if you go back 5 years later, 7 years later, their efficiency is nowhere close to what was proposed. And that's not a function of people not being aware or intelligent or ethical. It's just a function of the vision that was put together when the community was built, and the operation, property management, facility management, and the tools and the electronic back office systems there have to be maintained properly. And unfortunately, they aren't. And I think that's an area that keeps me up at night. I get excited about what the world could look like if Tribe can actually come up with a genuine, not just for PR purposes, but like a genuine group of products and technologies that can be installed in these communities and literally lower their carbon footprint, and to a point where we can actually start offsetting that with actually carbon dollars coming into their bottom line to actually affect the operations. You can see how amazing of an opportunity that would be. So I'd love to see less talking about that and more doing, both by the government and by the private sector, to bring products that are cost effective to the market.
Well said. Listen, a couple questions left here. We always like to ask from an investor standpoint, what do you suggest? What are the metrics or maybe catalysts that we should be following closely to really understand that you guys are executing on your business plan? Revenue is easy. right? It's easy to do that, but what other metrics should we be watching for?
I think our retention numbers are incredibly important because it illustrates that the model is really working. I think our microeconomics, it is revenue, but it is microeconomics, are very important. Our ability to continue to generate more per home while we're not raising maintenance fees on these communities is a massive kudos to the model being really working. And then digital services, it's anemic right now, it's growing. But that digital services number, if we're doing that well, it literally is the blue sky. We can unlock tremendous revenue streams from there. I would say these are probably the biggest areas in our business to keep an eye on.
Yeah, I imagine the amount of data that you guys can clearly have access to at that sort of potential point of sale for so many different services. It's pretty impressive. Joseph, last sort of thing is we always like to let you guys have an opportunity to just leave a parting message or a key takeaway. Really, what do you want everybody to understand about the business today? Make sure they walk away with today.
Yeah, I mean, look, there's very few industries that have yet to really be disrupted. Everybody here will have had a headache listening to stories about disruption. I get it. It's a cool thing. It's a wonderful thing. I'm an investor too, and I'm the first to fall in love with it. But really, genuinely, when you look at where digital transformation can really make a massive impact, prop tech is a big buzzy word and very exciting, but a lot of that money that got raised and spent went into real estate transactions, went into IoT and smart building technology, which we just discussed and unfortunately hasn't seen the other side of the river yet. And then payments, rental, and how do you pay this easier or get access to it? Unfortunately, very little has gone into the most important part, which is the operations of these communities. And you're looking at a company, I wouldn't say we're alone, we're still unique and probably more equipped than most, but you're looking at a company that I think can really make an impact there. And from a Catalyst point of view, watch us be active in bringing these companies on our umbrella and continue to grow. Watch, and I hope that we can put the Canadian flag high, and I'm proud in being a very, very innovative company down south as well as a company that's really changing things. And then finally, I got to tell you, we just a company with a whole bunch of good people, and me. I don't know if I can put myself there, but a great group of people that wakes up every day literally obsessing about the quality of living of our customers. So it's something we're proud of.
Helping to make people live in better environments. I think that's a noble goal for sure. Listen, Joseph, if somebody wants more information, what's the website address, or how should they, get more information on the company?
TRBE.com is our URL. It's the deck that you saw today is there. A lot of other press releases is there. TRBE.com, and obviously our TSX.V, it's TRBE. TRBE is our symbol. Thank you so much.
Fantastic. So we've been speaking to Joseph Nakhla, CEO of Tribe Property Technologies, symbol TRBE on the Venture Exchange. Joe, great to catch up with you today, and continued success.
Thank you, Paul. Thanks, Trevor. Thanks, everyone. Have a good one. Stay safe.
You bet.